Thank you again for being here. I want to echo Lacey. We're really grateful you guys would invest an hour of your time into us and about what we do, and hopefully investing an hour into learning more about the market and how you guys can better navigate it and help your clients navigate an increasingly complex and dare I say fast-paced market. And with that, let's kick things off. All right, so let's start on a little bit of a light note. Belief is what you do when there is no data, right? Without data, you're just another person with an opinion. Of course, my personal favorite, data is the new bacon. And this is really what it comes down to, you guys. We're drowning in information, and yet we're starving for wisdom. So one of our goals here today is to hopefully leave you guys with a little nugget, a little kernel of wisdom when it comes to the marketplace. Quick rundown of our agenda. We're going to start with some short-term and then kind of go into some longer-term trends. We're going to talk market segmentation because we know that not every part of the market, not every sector of the market is behaving the same. I'll try to give you guys a quick sneak peek of our March numbers, even though we don't go live officially until tomorrow. But because you guys are investing some time with us, I think we can give you a quick sneak peek. And then time permitting, we're going to go into an InfoSparks training, and then we may not get to our economic update. That's kind of a just in case we have it, but we want to get to questions for sure. So we'll leave some time for Q&A. Okay, so 3 overarching trends. We've sort of been covering this each month. Each month, obviously, the numbers change. So the numbers change, and so sometimes the dynamics can change. Overarching trends in terms of high level, macro trends, buyer activity still remarkable, right? Relentless, incredibly strong. 2020 broke records. I suppose here we are in April. Maybe we should stop talking about 2020. But both pendings and closings reached their highest level annually since at least 2003, probably earlier. Last year sellers barely budged. New listings were up a meager 1/10%. But then we saw this spike in December. But now February and March have been down double digits, right? So lately, I should say most recently, new listing activity in March, so seller activity was down about 11.5%. So we are seeing some mixed signals. I don't have to tell you guys, inventory is by far the biggest challenge, the biggest struggle, the factor that's pushing prices higher and market times lower, and the ratio of sold to list price higher, and it's really impacting basically all of our metrics, really, including affordability, including absorption rates, and so on. So active listings, homes for sale, are down 3/4, 75% over the last 10, 11 years, while sales and population have only increased. All right, so let's talk about just 4 thoughts, if you'll humor me. I want us to think about this as we're thinking perhaps some stabilization, maybe not 10, 11% price growth. Maybe we think more about 5 to 7% price growth for a few years. But I just want to get our thinking hats on. So eventually the market could push back against rising prices, right? And there's always the possibility that could kick off the next market cycle. Given where supply and demand are, and given where interest rates are, I still think that's a decent ways off, but that can change. So rising prices could and should incentivize more supply. That's from ordinary sellers like you or I, but also builders like Lennar and Pulte, and I think M&I was gobbled up by someone, but so on and so forth. Weekly, Gagne, right? The list goes on. So homeowners for now are kind of enjoying the ride up, and they're remodeling. They're staying put for longer, especially baby boomers. And then my little quote in parentheses here sort of speaks to that 4th and final point. Where else would I go? So the shortage becomes a self-fulfilling prophecy. I won't list my home because I have nowhere to go, and there's nowhere to go because I and my neighbors won't list our homes. Sort of a little bit of circular logic there. I hope you noticed. All righty. So let's talk showings. And I just want to say a word about why we include this and talk about this. And I've actually invested some time into, making sure that we can do this for you guys, making sure we can track showings. It wasn't a part of our normal process. We didn't really have a report before COVID in the pre-COVID era. We didn't really have a report on showings. We didn't really have any showings numbers. And we've since been mining some of that out of Matrix from the North Star, and of course the showing time data. One final word, I'll just punch the dead horse a few more times. Of course, showing activity is a leading indicator. It's one of the best leading indicators that we have, meaning it's the thing before the thing, right? Before you sign a contract, before you sign an offer, I should say, before you write an offer, there's a pretty good likelihood you went to a few showings, right? So as we see showing volume, showing activity on the rise, we can expect pending sales or the number of signed purchase agreements to follow, right? To also be strengthening, to also be on the rise. So just really quickly here, we've got our sort of green color 2019. You guys can see the showing trend from 2 years ago. Then last year, 2020 in gray, pretty clear to see, right, guys? We've been talking about this for months. Pretty clear to see the COVID signature here. The impact is quite clear. But then, as we've noticed, activity started hovering above that year ago level, which is why we thought, accurately, might I add, we suspected that sales also would reach a new all-time high because showings did. And showings are the thing before the thing. So it's a leading indicator. Guys, check out 2021. Check out this year so far. It's really remarkable. It's truly, truly remarkable. This is through the 11th, so I believe that was Sunday. Good Friday and Easter, some of the holidays have fallen, a little bit differently than years past. But I think the moral of the story is showing activity is still remarkably strong, which means buyers are still motivated, interested, feeling good about interest rates, and feeling like they maybe need some more space. So let's talk about the number of showings for the most recent period this year. Now, careful here, you guys. We're actually comparing to the same week in 2019. Why? I don't think I have to explain why. Because if we compared to April of 2020, that wouldn't really be an apples to apples comparison, right? Just because of the COVID impact. So it is important to go back to perhaps what you might call a more normal year, a non-pandemic year. So we are comparing to 2019. So just so you guys know, I know this looks extreme. This isn't just 1 year. This is 2 years of change. So this is 2 years of change. However, even 2 years, right? Showing activity between 300 and 400,000 more than doubled in 2 years, right? So from 3,300 to 6,600 would be doubling, but here we are at 6,900. So again, quite a remarkable showing there. Here again, guys, 2,500 to just about 5,000, doubling showing activity in 2 years, right? So pretty remarkable there. And on and on up the price ladder. Here's million plus, right? 310 doubled would be 620. We're at about 650. The only segment where we see declines in showing activity is, of course, in our most affordable range, under 200,000. When it comes to the sub 200,000 market, there just isn't that much product to show. So it's hard to have more showings on a shrinking pool of product. This in particular, and remember, guys, sellers in this segment probably aren't listing either. So it's really, if you want to talk undersupplied, this is obviously where it's the most notable, the most dramatic. All right, so here's our little pie chart joke. Haha, the plate is the pie I have eaten. The custardy, pumpkiny, maybe sweet potato color is the pie that I have yet to eat. Let's talk about the share now, you guys. So again, most recent week here in our kind of pinkish purplish color is the week through, is our most recent week this year compared to the same week 2 years ago. Just be aware, you guys, that we're not 21 to 20, we're comparing 21 to 19 here. All right, so here's our most affordable range, sub 200. You guys can see went from 27.5% of showings down to 16% of showings in 2 years. We also had a decline in the share of showings between 2 and 250. Now, some of you may be wondering, well, I thought we saw an increase in the number of showings, and you're right, we did. But notice how all other segments had a much larger gain, meaning this actually lost share. even though it was an increase in number, it was actually a decrease in share because so many of these other segments grabbed some of that market share, if that makes sense. It's a little bit of a wonky thing, but just know that it's real. And yeah, million plus, about 1.1% of showings, now about 1.7%. So we've seen quite a bit of growth in million plus, and time permitting, we'll kind of hop into that a little bit later. All right, so just thinking about the change, you guys, overall, and here again, 2-year change. So be careful here. 2-year change overall of about 35%. So 35% more showings than the same week 2 years ago. Who are our biggest gainers? Looks like million plus to me. Lots of showing activity, million plus. And then, of course, this 3 to 400 market. I should say this 3 to 400 range, up over 100% in 2 years. Obviously this is luxury. I think of more of this as, I don't know if we can call this entry level now. I think of this as kind of where the median is, because lo and behold, it is where the median is. I think we're at 325 or so. I think we'll be between 320 and 330 for a couple months here. And obviously that median is right within this range, which means a lot of the demand is right there. New listings. Okay, these next two are some of my favorites just because I like the way they compare new listing activity from this year with seller activity from the prior 3 years. Where should we begin? 2021, this kind of bluish grayish color here. Wish I had better news to report for you guys, but I see new listings pretty low, not that much higher than the COVID dip here. So this is 2020 here in orange. Notice we were actually off to a pretty strong start in terms of new listings, and then enter COVID, and you guys can see the impact. What's a little bit concerning now, maybe more than a little bit concerning, is the fact that this year we're just not seeing gains. We're just not seeing gains in seller activity, and that's really becoming a challenge. So you can see 2020 here kind of getting back on track versus what you might call 2 normal years, 2018 and 19, sort of following each other pretty closely in terms of seller activity. Let us switch over to the buy side. Over on the demand side, you guys can see 2021 signed contracts, pending sales, really strong still. You can also see they were actually off to a record start, well, record at least in the last 4 years, and we know actually a record overall for going back quite some distance. So 2021 looking pretty strong, still pretty strong. A little bit of a dip. I think that's because of a holiday. I think we'll be back up here in no time. And then again, as long as we're on this demand indicator, just check out last year, just in case any of you missed it. Here's the COVID dip. We got back on track by what looks like end of May. So let me pause here, you guys. Remember how we were comparing to 2019? And it's because we can't compare 2021 here, right, to 2020 down here. However, I think we're only going to have to do that for a few months, maybe a couple months even. By the end of May, it looks like we were kind of back on track. So I think we'll go back to 2021 to 2020 comparisons instead of 2021 to 2019 comparisons. So that's an important point, right? It's not really useful to compare to this because it's just a different market. I suppose it's still interesting to see just how high off this valley we are. So I guess that still has some value, but in terms of, comparison, obviously there's some challenges with comparing to last year. And then after we got back on track last year, I love this, you guys, because notice our showing indicator did its job perfectly. It was a leading indicator, right? It was a front runner for this trend. It told us that this trend was waiting in the wings. Sure enough, it came to fruition. So again, don't discount some of the showings analysis. New listings by price range, most recent week this year compared to, again, same week 2 years ago. Change in new listings from 2 years ago looks like 3/4 of a mil up to a mil. This is our highest performing segment in terms of seller activity. 63% more new listings over 2 years. So what is that? 30% per year, roughly. 17% million plus, still pretty substantial. So it looks like our luxury segments are the only ones with gains in seller activity. overall, we were down about 19%. Of course, in our most affordable range, right, down almost 60%. Listen, if I own one of these, you can't pry it from my fingers, right? It's hard as you get down there. Change in pending sales by price range. So again, current week versus 2 years ago. Those sellers, they're not crazy, you guys. Look at sellers in these three ranges here. They're not crazy at all. Look at the demand. The demand is growing, right? Look at pending sales. Look at where we see this growth, luxury. We really see a lot of growth in luxury. Historically, million plus is our, official elite luxury bracket. But maybe this is, I always have fun. Young luxury, entry-level luxury, bronze luxury versus our silver and gold class. I don't know. But you guys can kind of see a lot of the demand gains year over year on a weekly basis anyway. A lot of those demand gains are in luxury. All right. Let's talk March, you guys. This is March 2021 compared to March 2019, right? Because the first half of March was fine last year. The second half of March was anything but fine. So overall, new listings up 7% from 2 years ago. You can see again in some of our, as we look at the different price points, you can see one of our biggest gainers, our biggest gainer was in $500,000 up to $750,000. We see some new listing activity in 250 to 350 over the last 2 years. That's encouraging because once again, this is the lion's share of our market, right? This is the bulk of our volume, of our sales volume and dollar volume, which of course makes sense because our median is right within this range. In fact, it's almost smacking, well, maybe not smack in the middle. I suppose lately it's been toward the higher end, right? Creeping ever closer to 330 and 340. Change in new listings, not a lot of seller activity as you get under 200,000, even under 250, you guys, you just won't see that much. You just won't see major gains in seller activity. Again, March this year compared to March of 2 years ago. Now over on the demand side of the equation, pending sales, signed contracts, same thing. Here you have it again, folks. 145% gain in signed contracts on 750 to $1 million over the last 2 years. Right? Pretty remarkable. Pretty impressive figure when it comes to maybe this mid-level luxury, even elite luxury and maybe affordable luxury. I forgot that term, affordable luxury. We do see some pretty robust gains there as well. This is just a summation, you guys. This is just summing up exactly what we just saw. This 144 and 61 are the same as this 144 and 61. Just know that we've plotted pending sales growth by price bracket alongside new listing growth by price bracket. So I think the key here is look at how sales, you guys, sales are falling more than listings in these affordable ranges, right? Sales are growing more than new listings in every other range, right? So 144% increase in pendings, only an 11% increase in new listings, right? 75% for demand, call it 25% for new supply. So pretty interesting. It's pretty clear to see demand outstripping supply. Maybe we should say demand growth far outpacing new supply growth, which should be a surprise to exactly none of us. Okay, so these next 5 or 6 or so, I think I'm saying this a couple times. These are my favorites. I really like these. I really like all of these. So March new listings, going all the way back to 2003, you guys. We want to show the run up into the bubble, the downturn, a little bit of our recovery or maybe wobbly seesaw here in terms of new listings for March. But I think it's important to not just show the last couple years, the last even 3, 4, 5 years. Long-term trends really are important. It's also important to think about where we stand today and obviously putting that in context, of the past, sort of anchoring that in the past and understanding what's happening, long-term. So this March compared to last March, right? Seller activity actually down 11%. Remember though, the first half of March last year looked pretty good for seller activity. We saw new listings rise, notably, in the first half of March. We saw that on our chart. So 6,600, I suppose we're above the 62 and that 62, and I guess that 66, and technically this 66, although not by much. But you guys can see we're kind of bouncing along the bottom here a little bit. I'm not sure we belong up here when we had a supply bubble, but clearly, I think we belong somewhere in the middle. Maybe we're looking for more like 8,000, 8 or 9,000. Remember though, guys, we look at these numbers and we say, that's a lot. Well, guess what? Demand is up here, right? Demand is up here, but seller activity is kind of still down here. So I don't know. That kind of gives us some ideas of the balance there, or I should say the imbalance. Just like we said, pending sales, there they are up there, right? Not quite breaking, or excuse me, breaking through this 05 figure, not quite breaking through March of 2016 and 17, not quite breaking those figures. 12%, nothing to sneeze at, right? 5,700, a very strong showing. For pendings, it was the third strongest March going all the way back to 03. So a pretty impressive record there. Closings, closed deals, actual closings, up about 3% to 4,350. Didn't quite break through this 2017 level. Came pretty close to 06, although not quite to that 05 level. So although we can't say, we can't say we quite broke through these levels, we definitely saw some nice growth, and that's encouraging. Days on market, market time, CDOM, cumulative days on market. This is quite remarkable. This is a pretty dramatic change that we've seen. 150 days. So if 186 months, 150 days is 5 months. Where do we stand today, my friends? 11 days. 11 days on market. That's the median, meaning half the homes take more than 11 days to go under contract. The other half of our homes take less than, I should say, fewer than 11 days before an offer is accepted. It's a fast-paced market. I think that's safe to say. It's a fast-paced market. 11 days is quite brisk, and it's almost 60% faster than last March. And even, March of, it's about a third. It's about a third of the market time that we saw in 2019. Again, half the market time we saw in 2018. Pretty crazy. Median sales price, money, dollars. Let's make sense of the dollars. Up about 10.5% to 328. Just like we said, we're in that 320 to 330 range there. 10.5% is pretty notable increase. Looks like our most significant gain since, it looks like we matched that 10.4 from 2015 here. And then before that, of course, 2013 was our other high water mark. 328, call this, okay, 227. Let's be generous and call this 228. We're 100 grand above bubble prices. We are 100 grand above. Year over year change, you guys. So we were just talking how we saw that 10.4, right? So here you guys can see our kind of 10% plus gains lately, right? Now we've been here before, after we got out of that Great Recession and the foreclosure and mortgage crisis. As we got out of that, we did see some pretty significant gains, right? 18%, several at 15% plus, and pretty much all of them for a year, almost 2 years there, were above 10%. We've had some periods of elevated price growth right here and here and here. And obviously here over the last 8, 9, 12 months here, clearly we are seeing sustained price growth, sustained and elevated price growth, at or above or around that 10% mark. Guys, it's lasting, quite some time. This has lasted. This seemed a little ephemeral, a little fleeting here, and I guess so did this. But we've been here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months, right? I think in the next couple of months, I suspect we'll have 12 months of about 10% growth. So that's pretty impressive. Hey, there's our friend Jeff. Some of you may have heard this last time. We always get asked this, so we like to just kind of lay it out for you guys and I think get ahead of some of the questions just because it's a common question. So let's talk median versus average. Mr. Bezos walks into a bar. 6 people belly up to the bar. Are we allowed to be belly up to the bar anymore? I don't know. Maybe they're sitting. Call it a restaurant, you guys, right? 6 patrons, and this is their incomes, right? 40 up to 1.25 per year. In walks Jeff with his $200 million in income. The average income for this group just went to $28.6 million, right? Kind of somewhere right here. What about our median metric? 65,000. Why? Half of the people earned less than that median. The other half of the people earned more than that median. I don't really care that he is much, much more beyond that median because he's still just one data point above, right? So 3 earning less, 3 earning more, that puts our median right here. Let's keep punching the dead horse a little bit. Here's Jeff Bezos, and I think this is more accurate, right, guys? 200 million, pennies. I think it's 200 billion. So what happens to our average? Our average just got dragged up to $28.6 billion, right? What happened to our median? It didn't move a penny, didn't have to, right? It's sitting pretty right here in the middle. Half the people are still making less, half the people are still making more. Look at how much the average is dragged up by this outlier. It's skewing our data, isn't it? This is why we prefer the median. This is why we usually utilize the median, but sometimes we will look at average. So average is, right, you sum all these together, you add all of these together, and then you divide out by 7, right? Well, when we divide that out by the number of people, our average is so skewed because basically it's allocating all of this across these other 6 people. The median doesn't do that. It just takes that midpoint. Now, let me say, average can be useful. Think about when we're looking at percentage of original list price, you guys. Let's say the median is 100%, meaning half the deals go for over 100% of list price. The other half go for less than or under 100% of list price. Well, sometimes the average might be 102%, which tells us of those that go, of the 50% that are over 100%, on average, they tend to be about 102% or about 2% above. Obviously, we want to do all the math on that just to make sure, but that's just one example of when perhaps an average would be useful. Okay, we're going to keep kicking the horse. Houses, right? We've got a 150, 2.25, right? All the way up to a 3.5 million. What's our average sales price of these? Six sales? Our average, 833. What's our median? 312.5. Why? Because we've got an even number, right? 3 and 3, we have to split the difference here. And that's where you get your 312.5. Right in the middle, you guys. I'm gonna climb out on the skinny branches and go out on the limb there and say that this is a better measure for these 6 homes, for these 6 sales than the average. So just keep that in mind. I thought we saw a chat or a question. Yes, so the median, very simply, Steve, thanks for the question. Excel is really good at doing that. If you've got a table of numbers, you can just do equals median, and then it'll give you a parenthesis, and you just kind of drag across your listings. But the way to think about it is you just line them up in either ascending or descending order, and you just find that midpoint where there's half above, half below. So yeah, give that a try. Or again, feel free to use Excel. It's a fairly basic function, but call or email if you need a hand. We're happy to help. So PPSF, you guys, price per square foot. PPSF, price per square foot. This is March. Of course, this is a median because I just talked about the value of the median, even though I think my next one is an average. So 140 per foot in 06. We're about 175 per foot here in March of this year, here just last month. That's a 13% gain, pretty dramatic. That is the strongest year-over-year growth since 2013, when we went from 85 bucks a foot up to just shy of 100 a foot. 100 a foot, God, why can't the math just always be that easy, right? 2,000 square feet, 200 grand, right? 4,000 square feet, 400 grand. It's never that simple. And here we are at about 175. So like we just mentioned, guys, percentage of original list price received. Very simply, the ratio of sold price to list price. So don't overthink it. It's really simple. What number did I just cite? I think I just said 102. So there you have it. I knew that was in my brain for a reason. 102% of original list price received at the time of sale, right? So sellers are getting on average 100% and then another 2%, right? To get to 102%. You guys will notice that is well above the levels from 03 to 06. It is quite a far cry from, the 09 through 2011 figures from the Great Recession. Of course, 2010 notwithstanding, because of that lovely tax credit that we had, and some of the Minneapolis Advantage money was also a thing back then. Clearly, something's happening here, right? Clearly, we are very undersupplied and demand is very strong. Clearly, buyers are outbidding one another. Clearly, we see a lot of multiple offer situations here. That's what's driving this figure higher. Kevin. All right, March inventory, active listings, metro-wide. We used to have 33,000 active listings, right? Homes listed under active status in Matrix. No worries, because we've got plenty today, right? Nothing to worry about, nothing to write home about. We can keep on moving. We're going to pause here for a second, guys. We were chopped in half, right? We were cut in half. The number of active listings went from 10,000 to 5,000, right? We were chopped in half. Really pretty remarkable. We've seen 25% down before. We've seen 20% down. 50% is pretty dramatic. Sellers just aren't listing them and buyers are gobbling them up. That's just kind of what's happening. Let me make a note though. Let me just make a comment here. It's important to think about methodology here. So here's a methodological note. I always like that word. Here's a methodological consideration. Think about our method, you guys. How do we calculate inventory? Inventory is simply a snapshot at month end, meaning we just take that snapshot of the properties in active, darn it, I hate saying that. We take a snapshot of the properties under active status. I don't want to say inactive status. We take a snapshot of the properties that are listed under active status at month's end. Think about this though. Let's say a property was listed March 10th and then it goes under contract March 20th or March 28th, right? It will not show up in inventory. And that's happening a lot nowadays because days on market is so tight, 11 days, right? Half of our listings go under contract in 11 days. So, that's been our method for, a decade and a half about. But it's important to note that that's really just the inventory that's left over at the end of the month. Now, some of this was listed in March. Some of this could have been listed in January. Heck, some of it could have been listed last September or October. I don't think much is lingering from those days unless it really doesn't show well and is way overpriced. But just know that this is sort of our residual left over. And just understand that, there could have been and were a lot of listings that came on during the month, but weren't active at the end of the month, right? Because they were under contract. So that's happening a lot more now than it was. So this inventory figure is going to look lower than it actually is because we had inventory come on during the month that wasn't captured at the end. All right. That's probably more than any of you care to know about our inventory methodology, but there you go, folks. Okay, we're having fun now. March months of supply, right? Similarly, you guys, chopped in half, right? Down 54%. We went from 2 months to about 1 month. You know what? I shouldn't round. We're not doing justice, right? I shouldn't round. 0.9 months of supply. Not even a month of supply. Down from 10 months of supply. We're shooting for 4 to 6 months of supply, maybe 5 to 6 historically. I think 4 to 6 or even 4 to 7 is a fairly balanced market where we're not favoring buyers, but we're also not leaning towards sellers. clearly since 2013, we have been in an undeniable seller's market, right? As evidenced by the fact that we have fewer than 5 months or even fewer than 4 months of supply. Now, there's a 3.3 month supply and a 3.6 month supply seller's market. And then there's a 0.9 months of supply seller's market. Yes, they're both seller's markets, but man, oh man, I mean, we just haven't quite seen this. And that's why things are pretty crazy out there. Let's think through this, you guys. Sellers markets. I know we also get questions about this. So I just want to make sure we all have our heads on straight with this stuff. Sellers markets, we've got these 1, 2, 3, 4 buyers. 1, 2, 3, 4, 5 buyers. I promise I can count. We've got 5 buyers and they're all competing over this listing, right? Because there aren't a lot of listings. So these guys have to compete. They like this one. It shows well. It's remodeled. It's got a new roof. It's got a furnace, right? It's a furnace in the last 5 years. It's in a good school district. It's on a quiet street without a double yellow line down the middle, right? Whatever. They're all amped up. They're all really excited to make offers. So sellers markets, right? This is what we see with sellers markets. It's a low supply, high demand environment like the one we're in. Sellers are at a pretty significant advantage. Market times are historically fast. Very robust price appreciation, fastest pace in what do we see? 6 years or so, 5 years, multiple offers, so on and so forth. Buyers markets. Here, there aren't as many buyers, right? But there's a lot of sellers. Well, relatively more sellers. So what we find here is that these 3 sellers are effectively competing with one another in order to lure in these buyers, right? Someone's going to lose out, right? So these guys are all kind of trying to outcompete one another with price reductions, concessions, seller paid closing costs, inspection lists, right? They're fixing stuff from the inspection list, from that list of findings, right? Replace this, put a GFCI in here, do this and that. And so, in buyers markets, again, marked by more than 6 months supply of inventory, this is a high supply, low demand environment where the buyer has an advantage. Homes tend to linger on the market longer. Prices can either be softening or glowing. Yes, prices are glowing. Nice, David. Prices can be growing, a little bit more slowly. They can also be glowing, I suppose. I like that. Prices are glowing slowly. The buyer has more negotiating power, and so on and so forth. Guys, we're shooting for this balanced market, 5 to 6, 4 to 6 months supply. This is what we're looking for, but this is what is just so elusive. We just haven't been able to stay here. It's like a pendulum, kind of swings from, kind of one side to the other, never really hangs out in the middle, doesn't spend a ton of time in the middle. All right, let's pivot. If you don't mind, let's pivot into affordability. We're going to dive deep into some affordability trends with our affordability dogs, Scuba Sam and Scuba Steve, Scuba Rachel. That's what we're going to do. Scuba Sam and Scuba Rachel. Okay, a disappearing act, you guys. What is happening to active listings under $250,000? I'll give you a hint. They're not on the rise. Looking at percentage of actives under 250K using our rolling 12-month average. We've marked our recession here. Why? Because notice that there were fewer and fewer listings under 250. And then as the recession entered, now we had more, meaning prices fell after the recession, right? Makes sense. And then, right, ever since 2012, prices have been not glowing, but growing. Well, maybe both. So check it out. We broke out the 2 core cities and then we've done the metro as well. So take a peek at St. Paul. 54% of their actives are at or below 250. And they've actually been pretty flat, on that measure. So, I know some of us have feelings about St. Paul. I happen to like St. Paul, but I know there's some Minneapolis folks who focus more on that side of the river. But you know what? They have more affordability than we do. And look at Minneapolis here in gray. 31% of our actives at or below 250 versus 54% on that east side of the river. Metro-wide, 23%. Why? Well, you got to think, you guys, in the metro, we've got the Wyzettas, the Edinas, right? The Prior Lakes, the North Oaks. We've got some of these luxury markets. And don't forget, we've also got a lot of new construction in the metro that we won't see, nearly to the same extent in the core cities. There just isn't the land. We see infill redevelopment. We don't see greenfield new development where we, take a new plot of land and build subdivisions on, well, usually it's old farmland. So yeah, metro-wide, about 23%, you don't have a lot of new construction. Heck, you don't have a lot of new construction under 3.5. I know there's some in the low threes. Maybe there's a few in the high twos, but very little of that is under 250. Sticking with this theme of affordability, let's take a look at the percent of pre-tax income spent on the mortgage of a median priced home. So basically what this is telling us is we spent 25% of our pre-tax income, right? If we earned the median income, we'd spend about 25% of that pre-tax income on our mortgage if we owned a typical median priced home, right? No, not everyone's earning the median. Some are above, some are below. In fact, it's a median, so half are above, half are below. And then of course, not everyone owns the median priced home. Half are above, half are above that, half are below. Another little follow-up lesson on medians there. So what do we notice about now? Guys, we like to complain a lot about our affordability challenges, and they are there, right? There's no doubt about it. But when we put on these glasses, when we look through this lens at the percentage of income spent on the mortgage, right, of that typical home, it's only about 18, 19%, right? Down from 25% in 06. What's going on here, you guys? It's a two-word answer: mortgage rates. I bet some of you were thinking of that. Mortgage rates, right? Even though prices are higher, prices are up here, the percentage of our income is actually down here. Let's stick with this. This one is our monthly PITI payment, our all-in principal, interest, taxes, and insurance monthly payment on that median priced home. We're making some assumptions here. We have to. We're assuming 10% down. I know some go 3. I know some go 20. We're assuming 1.2% of the value paid in taxes. So think about that. On a $300,000 home, what is that? $3,600 a year in tax. So that seems pretty right based on our analysis. And then 0.5% annually toward insurance as well. So we've done that math and we've found that about $1,600 a month, right, on that median priced home at current interest rates. That's less than where we were in 06, right? Now, this does not account for inflation, but I think this is pretty interesting. Check this out another way. So we've got that monthly payment, right? This guy. We've got that corresponding to our left axis, and then look at our median sales price trend in green here, and we've got that corresponding to our right axis. I think I should have said axis, not axis. I think that's plural. So take a look, you guys. Look at the gap that we used to see. There was a huge gap between payments and prices. Why? Interest rates. How about now? We have almost no gap between payments and prices, right? Based on this. Why? Interest rates. Look at this. Even though 230 up to 305, prices are at an all-time high. Payments are pretty flat. And again, thank you, interest rates. It's been a blessing from above. Price to income ratio, about 3 to 1, right? 2.9 to 1. You guys, the math could not be simpler. Incomes are about 103. That's the household, or excuse me, that's actually for a family. Often that's 2 wage earners each making 50, 52. Maybe one wage earner is making 70 and the other's 33. Maybe one spouse or one partner or one family member doesn't work and the other's making 103. Remember though, this is a median. So there's people in this metro that make millions and there's people in this metro that make 0. So this is a median and our home price is 305. So that price to income ratio, 300,000 divided by 100,000, that's 3 times our incomes. We have to spend roughly 3 times this income to buy this median priced home. All right, I hope I've explained that sufficiently. So 2.9, call it 3, just about matched up with this 05 ratio, right, where we spent 3 times our incomes to get a home back here as well. So by this measure, right, we are spending roughly the same ratio, the same multiple of our incomes as we did in '05. Maybe that's cause for concern relative to ourselves, sort of internally relative to our past. How about relative to our peer cities? What's going on with our friends in the Bay Area? San Francisco, median family income. Minneapolis, St. Paul, median family income. There's our 103.4. There's their 143.1. So they earn about 40% more than we do, which means their home price could be 40% more than ours if they wanted to maintain our same affordability. So let's call it 50%. So what would that put them at? 300 plus 50% would be 450, right? Let's be generous, round it to $500,000. Nope, you got to actually multiply that by 3 because their median price is $1.6 million. A $1.6 million home price divided by 143,000 a year median income equals 11 to 1. Those our friends out in San Francisco, they have to spend 11 times their incomes on housing. Even our friends in San Diego, Seattle, right? 6 to 7 times. Denver, Phoenix, Atlanta, Charlotte, Boston, right? 4 to 5 times. And I like to say I did see Pittsburgh below us. I wasn't able to easily find data for Chicago, Detroit, Columbus, St. Louis, and some other metros that could be below us. So just be aware of that. Median house sales price, average house price per square foot. Median condo sales price, average condo price per square foot. Don't read too into this, guys. 16, 17, 18, 19, 20. Well, $1,150 a foot. Now they're down to $1,100 a foot in San Francisco. So let's be conservative. $1,000 a foot. Okay, $1,000 per foot means my 2,000 square foot Bloomington Rambler built in 1958 would be about $2 million if you uprooted it and plopped it down in the Bay Area. Pretty interesting. I think on a good day, it's probably worth $325, $330. All right, so sticking with some of these long-term trends, and let's do a quick time check. Oh gosh, 10 minutes. You guys let me ramble for too long. So average sales price, you guys, here in green, you guys can see the run up to the bubble and then the downturn. Here was our party. Here was our hangover, I like to say. But notice, guys, this is the channel, and this channel represents sort of the average growth rate. Obviously, we've been above that growth rate for some time. We've also been below that growth rate, that rate of growth for some time. What this is telling us is that we're not yet back in this channel. And this is kind of that long-term sustainable channel, and we're actually not even back in it. This is not consistent with a bubble. This tells me that there's some runway, there's some room to run. Yes, prices grow at about 2% after inflation. You guys are not lying to your clients when you say that. It's about 2%. Let's just, again, stick long term. Here's new listings in green, closings in our darker color here. Look at the run up in supply into 05, 06. Look at this run up, you guys. Now, buyers came along for the ride at the beginning when some of our lenders, and you know what, guys, there's enough blame to go around from agents, appraisers, lenders, elected officials, right? Assessors, you name it. There was shared responsibility. Our lending community did come up with some exotic mortgage vehicles, right? Some pretty creative financing vehicles that brought buyers along for part of the ride. That was not sustainable, right? But we still had this huge supply bubble. You had to liquidate this stuff to get it sold. You had to concede. You had to do price reductions. Those reductions then became comps for other sales. Think about that. Where are we today? We do not have a supply-driven bubble, just the opposite. Just the opposite. Look at how tight supply and demand is, right? Now, some will remember, how tight the market was at the end of the 90s, kind of heading into that 01 dot-com bubble crashing, right? Look at how tight things were. Things loosened up here, things very much loosened up here, and things are very, very tight right now. Okay, guys, let's just spend 2 minutes on Minneapolis, and then I really want to jump into InfoSparks. New listings, Minneapolis up 3% to 755. That's the highest level since 2011. Pending sales, Minneapolis up 33% to 613. That's the highest March on record, going all the way back to 03. Meaning what? Minneapolis just saw the highest new listing figure since 2011 for March, Minneapolis also saw the highest pending sales figure since 2003, but likely earlier and possibly ever, right? Possibly ever. All we can say with certainty is that it's the highest since at least '03, because that's when our data is valid as of. Here's an interesting one. Urban market share. Remember the condo activity when everyone kind of came back to the city, '08, '09? Look at how much Minneapolis and St. Paul were making of our look at how much Minneapolis and St. Paul were comprising of our overall sales activity, right? 23, 24%. Then we saw it decline. What are you guys seeing now? I'm actually seeing urban market share is growing, right? It's growing. We see sales rising in the cities faster than in the metro. Now, the opposite was the case, in the middle of last year. So we are seeing some changes there. Okay, just a really quick word on luxury before we shift gears. Oh gosh, 6 minutes. Luxury, you guys, lots of headlines about it. I mean, it's just kind of a sexy topic nowadays. And is it rooted in truth? Let's take a look at the North Star data. Closed sales above 1 million monthly, March, 90 last month, nearly a 60% gain, right? And nearly 3 times the volume that we had in '05. So luxury is a growth market. There's no doubt about it. Let's look at the year-to-date number for the first quarter, right? So Jan, Feb, and March, up 50% from the same period last year. Almost 200. Pretty remarkable there. Okay, just thinking through applications, you guys, you can use this stuff to directly provide better service to your customers, to your clients, right? Are we in a buyer's or seller's market? Look at month supply. How does townhouse condo compare to single family? Is median sales price rising or falling? How many days on market will it take to sell my home? Reasonably, how much of my asking price will I receive? Percentage of original list price, right? All right, let's shift gears, if you will. And I want to hop into InfoSparks really quickly, you guys. And that's not what I want, but I want this guy. Okay. InfoSparks. You guys can see I was looking at Minneapolis Central and Minneapolis, but I want to just kind of go high level here. So month supply, let's get off of our 3-month, right? So this is Minneapolis. We can go to the metro as a whole. There's our 0.9, right? Let's do a breakout. Let's do a quick property type breakout, just so you guys can see some of these trends. Already, I see a pretty clear one. So look at condos. Even though the market is recovering, we do see increases in absorption rates. So notice single family absorption rates down 60%, townhome absorption rates down 47%, condos up 13.5%. And look at red. Look at what's happened. A pretty noticeable change. How about market times? How about days on market? A pretty noticeable change with condos. Market times are shrinking for single family and for townhomes. They're growing just a little bit, 6% for condos. And again, you guys can kind of see how that looks. Another metric, percentage of original list price. Townhomes, 101.7. Single family, 101.6. Condos, kind of the laggard, bringing up the rear there at 98.6%. You guys can see there are clearly some differences here. And it's important to note. We are getting close to time. Let me throw in just 1 or 2 more. I'm going to throw in Minneapolis. Maybe let's look at sales price. So the region is up about 10.5%. Minneapolis about 6.5 or 7%. Month supply, let's see some differences here. So 1.4 months in the city versus 0.9 months in the metro, in the region. And, there's a ton of other ways to look at this stuff, you guys. Let's do a quick new construction breakout. So I'm going to take my property type filters and breakouts off. And now I'm going to go to new construction and I'm going to click on my breakout there. So now I'm looking at new construction in blue versus existing or previously owned in red. You guys can see new construction absorption rates have really come down, right? 2 months versus, obviously under 1 month. How about the pricing on this product? About $435 for new, 315 for existing. And if that is a little bit too much volatility or a little bit too much noise for you, just switch to the 12 month. Easy peasy. I won't go on, you guys, because in our last couple minutes, I think I want to open it up if you guys have any questions. So I'm going to check Q&A and chat here. I don't see anything new. I'm hoping that means there aren't any pressing. Oh, I see one. Steve, how are high material costs and shortage? Oh my God, Steve. I mean, I think you nailed it, right? I think you nailed it. It's really been an unfortunate piece of the pie. Just looking at lumber prices, I've seen what I think I saw almost $1,000, $1,000 per foot, or sorry, $1,000 for 1,000 feet. So this is $850 for 1,000 feet. What is that? $8.50 per foot of board. That's pretty crazy. So yes, it's definitely impacting the market. There's no question about it. I've heard a sheet of OSB has increased 5 times. And so the figure that I've heard, and I believe this is national, the figure I've heard is that changes in the lumber market have added $24,000 to the cost of building a new home. And again, I think that's national. So that could be skewed by California, New York, and Illinois, and Florida. But that's a pretty remarkable thing. Guys, unfortunately, we put a tariff on Canadian pine. I think that was 2017. The prior administration made that decision to put tariffs and engage in something of a trade war. So, that obviously added a lot of costs to importing lumber. I think we're looking at that. I think we've taken that down a little bit, but we also want to make sure our lumber companies are competitive. So we want, to even the playing field, but we also don't want to burden our builders. All right, Brian, since the beginning of April, are you starting to see an uptick in supply? Not really. No, not really. When you look at the data, no, honestly, not really. I think the magnitude of the declines is a little bit different. When you talk about inventory, single family down 56, townhome down 43, technically condo inventory up 16%. I suppose that's good news for buyers if you're buying a condo. I know we are at time, and I think we got to have kind of a hard stop here. If there's anything else urgent, go ahead and throw it in. Otherwise, please email or call, and we're happy to address any questions after our session here. Thank you, Steve, and thanks for joining us. We really, really appreciate it. How do you like that? An on-time finish.
I agree. Thank you, everybody, for coming. Keep an eye out. We'll have the recording and the slide deck posted to our website in the next couple of days. Thanks so much.
Thank you.